Hey there, future investors. Welcome to Finance Zoom channel, where I take you on an exciting journey into the world of stock market investing. If you've ever wondered how to grow wealth, achieve financial independence, and make informed investment decisions, you're in the right place.
Don't worry about it. Don't panic.
In 1990, Peter Lynch retired as manager of Fidelity Magellan, the nation's largest stock mutual fund, and one of the most successful. In 13 years, he drove Magellan to a 2,800% gain. Quite simply, Lynch has been recognized as one of the greatest money managers ever. He beat the stock market for so long not by timing the market, but by picking the right stocks. Of course, no one can promise you Peter's record, but you can learn a lot from him. And you don't need a billion-dollar portfolio to follow his rules.
In 1990, Peter Lynch retired as a manager in one of the nation's largest stock mutual funds, Fidelity Magellan. Successful for 13 years, he drove the company to a 2,800% gain. That recognizes him as one of the greatest money managers known. Consistently beat the stock market by timing and choosing the right stocks. And by this, you can learn from him that you do not need a billion-dollar portfolio in his rules. Now you might ask, can a beginner invest in the stock market? I have this stereotypical thinking that stock market investing is for the educated. While this can be an advantage, simply saying stock market investing only needs skills, intelligence, patience, and a little research. As exciting as it sounds, beginners must understand that the stock market can be volatile. Prices can swing dramatically in the short term, driven by factors such as market sentiment, economic conditions, or company news. Stay tuned as investor Peter Lynch discusses how a beginner can invest in the stock market.
That doesn't seem like a big difference, does it? But the power of compounding makes an enormous difference over time. Suppose you invest $50 a month and earn 6%. After 30 years, you have over $50,000. When your investment is taxed, the government reduces your return every year. If you know you won't need the money until retirement, you should place as much of your investments as possible into tax-deferred accounts, like IRAs, POs, 401k, or 403b plans. Because you don't pay taxes on the money until it is withdrawn from the accounts, the power of compounding achieves the maximum effect.
1. The power of compounding. Over the past 60 years, stocks have consistently outperformed other investments, delivering an impressive average annual return of 10%. In comparison, bonds only produce around 6%, and treasury bills offer a meager 3%. While these percentages may seem small, the magic of compounding can turn them into substantial wealth over time. One must understand the power of compounding in investing. Compounding is when you reinvest your returns. You earn returns on your initial investment and the accumulated returns. This snowball effect accelerates your earnings, significantly impacting your investment growth. As Peter Lynch highlighted, the longer you let your money work for you, the greater the impact of compounding. Let's illustrate this with an example. A 20-year-old investing $200 a month with a 10% annual return will have a staggering $1.1 million at the age of 60. Even a 35-year-old investing $800 a month can achieve the same $1.1 million by retirement.
Investing is a personal thing. You have to do it by yourself. You don't do it with a committee. You have to be able to have the emotional strength to stand the volatility of the market in general and stocks in general. The key organ here is not the brain. It's the stomach. You have the stomach for this. You have the patience for it. You should be able to look in the mirror and say to myself, what am I going to do if the market goes down?
2. How to research stocks. As a beginner, what should I invest in? According to Peter Lynch, investing is personal, and you must do it yourself. Researching stocks is like peering into the heart of a company. It involves gathering information to evaluate a company's financial health, growth potential, and overall performance. So, where do I start? First, define your investment goals. Before you begin researching stocks, clearly define your investment goals. Are you seeking long-term growth, stable dividend income, or a combination of both? Having a clear goal will help you identify the right stocks for your portfolio. Second, Utilize reliable information. The internet offers vast information, but not all sources are equally reliable. Stick to reputable financial websites, official company reports, and financial news outlets. These sources can provide you with accurate and up-to-date data. Third, analyze financial statements. Financial statements are a goldmine of information. Dive into a company's balance sheet, income statement, and cash flow statement. Pay attention to revenue growth, profit margins, debt levels, and cash flow trends. Lastly, study industry trends. Keeping an eye on company news and industry trends is essential. Look for any recent developments, product launches, or management changes. Understanding the broader industry trends can help you gauge a company's position in the market. Remember, stock research is an ongoing process. Continuously monitor your investments and stay informed about market trends. As you gain experience, your research skills will sharpen and your investment decisions will become more confident.
Just make sure you understand that plan and include it in your story. Once you've built the story for your company, you have a powerful tool for judging the stock. But like any powerful instrument, you must use it wisely and carefully or you'll get burned. Use your story to pick the right time to buy a stock. I promise you that the right time to buy a stock does not occur often. When I'm following a stock, buying opportunities present themselves once or twice a year if I'm lucky. I look for times when the potential upside is high and the potential downside is reduced. Understanding that balance is a key to successful stock investing.
3. When is the right time to buy stocks? Now that you have researched the company you want to invest in, the next question is, when is the right time to invest? The truth is the right time to buy a stock doesn't come knocking every day. Attempting to time the market perfectly is a daunting and often fruitless task. Stock prices can be volatile and influenced by numerous factors, making them unpredictable in the short term. Remember, balance is the key to successful stock investing, and stock picking is a risk-reward trade-off.
You have to understand, stock picking is a risk-reward trade-off. You have to know how much you're going to lose if you're wrong and how much you're going to make if you're right. The skill is to minimize your risk and maximize your reward. You can be wrong in this business. I've been wrong quite a bit, but you can be wrong and still make money.
4. Risk and reward. Investing involves risks, and every investor should be aware of the potential consequences of being wrong. It's essential to understand both the potential losses and gains before making any investment decision. Risk management is all about finding the right balance between taking calculated risks and protecting your capital. As an investor, you must assess how much you are willing to lose if your investment doesn't go as planned. The skill lies in minimizing your risk exposure while seeking opportunities with a favorable risk-to-reward ratio. Always strive to find investments where the potential reward outweighs the potential loss. As an investor, it's crucial to accept that you may be wrong at times. In fact, even seasoned professionals make mistakes. The key is not to be discouraged by occasional losses, but to learn from them. As I conclude this ultimate guide, I want to emphasize that investing is a continuous learning and growth journey. The stock market is vast and ever-changing, and there's always something new to discover. Investing is a journey, and it's okay to make mistakes along the way. Learn from your experiences and continuously improve your strategy. Always stay informed and keep track of your investments. Finally, remember that the most important investment you can make is in yourself. Knowledge and understanding are the foundation of successful investing. So stay curious, stay informed, and let your financial journey be one of empowerment and prosperity. If you found this guide helpful and empowering, give this video a thumbs up and subscribe to my channel for more valuable investment insights. Feel free to share your thoughts or questions in the comments below. Until next time, happy investing, and may your journey in the stock market be filled with growth and financial success.